Good morning. Over the last 3 weeks, I had the opportunity of spending time in the United States, across Europe, and in Asia. And this is what I came across. First, United States, the tariffs level are creating uncertainty, the economy is softening, and some level of tariffs are acceptable, but not too high, because ultimately the economy is dependent on trade, and any level of tariffs, which is way above what happened in 1929, run the risk of being highly destabilizing of the economy. In particular, this applies to Canada, Mexico, and China, which are the three key trading counterparts with the United States. As we have seen, after the announcement of Liberation Day, there was high pressure on the US equity market, but most in particularly on the dollar and the US Treasury. More and more global investors are hedging the dollar because they don't trust this administration on a strong dollar policy. All what they're doing is weakening the dollar. And most importantly, there's going to be $2 trillion issuance in the coming years. That means in the next 4 or 5 years, the United States will have to fund an extra $10 trillion. It's a staggering amount of money, which cannot be found easily unless they return to growth and with very stable and long-term policy, which do not appear to be right now the base case from this administration. Europe is finally waking up. I think Germany has been the first country to declare a clear change in industrial policy. Hopefully more European countries will follow. Capital is coming back in Europe on the back of this, and I think new spending, new capital investment might attract more capital, and probably also inside the euro area as a currency. Financials, the best placed position in Europe. They are the cheapest, 7.5 to 8 times earnings, all-in yields, dividend plus share buyback above 10%. So best place to be. Third, Asia. China remains cheap. Xi Jinping has understood the needs of private sector back at the table, as demonstrated from the meeting reintroducing Jack Ma on the scene and shaking him with a big smile for every other entrepreneur. And I think there is great value in China vis-a-vis the rest of the world. The classic US position is China is uninvestable, while BYD is the largest automaker in the world, is on 15 times earnings, Tesla more than 150. So I doubt a ratio of 10 to 1 makes China investable. I would say the opposite. And if anything, today, too much capital is in the States and not enough capital is within China. So we would add at the margin some exposure to China vis-a-vis the United States. Last but not least, currency. Dollar is overvalued by 10 to 20% and is finding alternative within euro and yen at the margin. The dollar remains the reserve currency, but in a way, its weight is way too high vis-a-vis the share of economy. They have about 60 to 70% global trade with an underlying economy that is less than 25, and people are looking to diversify. Diversify, first of all, from a risk perspective, and diversify because there is massive Treasury issuance coming our way in the next 4 or 5 years, with a current deficit plus tax cuts, with an estimate of more than 2 trillion issuance per year in the coming years. With this, that means the yield curve will likely be steepened. That means more nominal growth, slightly higher inflation. All this is conducive for a great environment in financials. And so we advise investors to keep an overweight position in equity and credit in financials, because this is probably the best macro drop that we've seen in many years to come, coupled with probably US deregulation, where the US administration is probably going to score real points, deregulating the industry, which has probably been over-regulated the last 15 years, putting pressure in Europe that eventually will have to follow suit. Thank you.